Happy Sunday, folks. Welcome to a live investing Q&A with myself, the passive income investor. As I have been pondering over the weekend, it's been my buddy's bachelor party, so I'm kind of recovering here today. But going into this weekend, I was analyzing some earnings reports on some of my highest yielding dividend stocks. And they do come with some red flags, my guys. And damn, it's a tough decision when you're looking at those 8% yields that are kicking out like $1,200 in dividends for the overall portfolio of income. And I want to get into this as people hopefully build into this stream because I want to get your guys' questions and answers about this. But before we do, I thought it'd be fun to update everybody because if you haven't been following the Bitcoin hack for the Poly network, I was just reading up on this as the hacker finally returned the vast majority of the $600 million. Like, think about any crime in history and just unbelievable, almost $1 billion in Bitcoin hacked, man. And this guy, like he returned half of it, which I'm sure you've heard, but over this weekend, he finally dumped almost the rest of it into a wallet that is locked. And these guys at the Poly Network still don't have full access to it, but the guy's claiming, hey, I'm going to give the vast majority of this back, but with some caveats because there's still $30 million apparently in Tether, not in those wallets. So this guy is playing a fishy game here. And I honestly think it's the most entertaining story I've ever followed when we're talking about like literally one of the greatest robberies in history. Not that the guy can spend it. I mean, you couldn't move that around in any way. You couldn't give it to your buddies anytime. I mean, we can watch the wallets, right? But yeah, so I just wanted to warm up a little bit while these guys stroll in, and then we're going to get into some of these dividend discussions. And I noticed some people are already throwing out some stocks like XQQQ, which I'll take a look at here in a sec. Actually, I'll pull this up on my phone. But yeah, I'd love to hear what you guys have for Q&As. If you have any things with dividend stocks, you want to talk a little bit about crypto. Like I said, we're just warming up while people come in here before I drop the scary news with some of my higher yielding stocks. But yeah, you guys should keep an eye on this robbery story because, like I said, it's fascinating the fact that this guy's talking to them. Imagine stealing $600 million and then talking to the person you stole it from. That's got to be an interesting conversation to say the least. But let me throw this up here real quick and see what you're offering. XQQ is the iShares NASDAQ 100 index ETF on the Canadian hedge side of it. So this is basically like a QQQ ETF or a QQQM ETF, but it is hedged, which is something that I have to look into. And it is up almost 20. It seems to be representing exactly the QQQ ETF. Those two are great for dividends. I'd have to take a look because I can't see it on this basic chart. I've been watching Spot and Scott's. Those aren't too bad either. But yeah, so before we get into too much of the Q&A, let's try and stick to the conversation that I wanted to keep up on here, and then we'll talk about some of these individual stocks. So when it comes to my highest yielding stocks, many of you are probably well aware that they absolutely sit in the sin sector, and Scott's Miracle Grow is the much better sin stock buy, but you're not going to be capping in the 8% yields that I am grabbing off, say, my MO, my Altria Group, or say something like my British American Tobacco. Now, these companies have been relatively flatlining. They have been fan favorites amongst incredibly large dividend investors in the community, of the likes of people like PPC Ian. But I thought things were pretty good during the pandemic because we saw more people actually smoking, and the number of reduced smokers was actually like flatlining for the first time in a long time. But going back into the second quarter earnings for MO, they saw about a 5% decline that ramped up a little higher than it has in the prior past, but that's not one of my main concerns. Actually, everybody knows that there's been a decline in smokers. That's old news. But the thing that concerns me the most is when you look at their earnings. I mean, the EPS numbers did great. They smashed it on that end. The revenue numbers are growing. But when you deep dive down beyond just the basic earnings release, it's funny how incredibly good this company is at playing around with their books. I mean, they're incredibly good at manipulating taxes. They also have been doing a great job at, these tax write-downs when you're talking about Juul that they lost a huge investment on. They're still writing down, I think they're still writing down Juul. I know they're still writing down Kronos Group, their big investment in the MJ sector. But the thing that was bothering me most about this earnings report was I listened to the earnings call for Altria. I am still diving down into British American, but these guys really push at how great their team has been at increasing the dividends, and like they're primarily dividend focused. They got a lot of cash going on right now, and I'd agree that their books look pretty robust. But I feel like sometime in the coming years, they're going to hit some kind of an inflection point, because when I'm looking at competitors that are coming up in the growth sector of this space, they're just I don't know why Altria hasn't got a foothold in any of these sectors yet, and it's been an ongoing event now for quite a couple years. They don't really have a foothold in the MJ market, and the biggest thing that they have, they're like the biggest thing for their future is how the regulation in the MJ market looks. But something tells me that the regulation isn't going to change that much in comparison to how it's changed here, even if you fully legalize the product. And I mean, we've all been kind of sitting on our hands waiting to see how the government's going to push legalization, and it's just something that doesn't seem to be moving forward that fast. So I'm not sure how long I want to wait to see what the government's going to allow them to get away with. Are they going to allow to sell their products in the stores through their distribution, like they do with the tobacco side of it? But after I've been working with some of these companies like TAT, and I look at some of the higher branded vape companies, when I look into some of the highest selling MJ brands, they're just not part of Canopy. They're just not part of Kronos. They're just not part of MO. Like, they're these really niche companies that most people just aren't aware of. And just Google it. Like, you think in this generation, after Juul, you got Views, you got all these ones with British American Tobacco, you got Philip Morris's version of this. They are not the highest selling vapes. And it kind of blows my mind when you look at how far down they are on the rung of people buying even vaporizers, which again, not a lot of people are buying vapes right now either. Those aren't like the most popular thing in the world. They seem to have a little bit of a niche in the market. So when I'm thinking about MO is a company that needs to have some kind of foothold in the future to make up for the loss, the continual loss that is at a high rate. A 5% decline year over year in smokers is going to compound pretty quick over the next 5 to 10 years, in my opinion, if that trend continues, which it seems to be. So I'm just concerned. I'm just really concerned that these big giants are having a hell of a hard time getting their foot in the door. They're getting regulated on their non-combustible products already. They talked about this in the earnings call. They're meeting a lot of regulatory headwinds across different states in the US. And you look at something again like TAT that are making hemp basically cigarettes, right? And they don't have any of the same regulations. They don't have the advertiser regulations. They do not have the shipment and distribution regulations, and they're just flooding these things into hundreds and hundreds of stores, and they're advertising with Floyd Mayweather, which Canopy tried to do with, say, Snoop Dogg, and that got shut down because of regulations. And I'm just like, why haven't they figured this out yet? Why are they letting all these competitors come into this market while they're still struggling just to get their stuff off the ground, and they're not doing a good job at that? I mean, they talk so happily all the time on the earnings call, and it's kind of misconceiving, especially if you just take it at a glance and you don't realize that they did a great job at reducing their tax expenses this quarter, which really led to a much higher EPS number. And I don't know how they're manipulating their taxes, but they're probably just doing it to these write downs and the various investments they have. But Kronos isn't growing like I'd like to see it. I mean, I'm just really concerned. I'm like, I love this 8% yield. It's not growing like the S&P, obviously, but you don't hold these stocks for that kind of growth. You're holding them for a reliable income. And like I said, I think they're going to be a great, reliable income source for at least the near-term foreseeable future, because their numbers, their earnings, their cash is just great. But again, there is going to be an inevitable inflection point if their primary, again, like, this isn't going to change, but I'm sure you heard that they were going to ban menthols, or they're trying to ban menthols. That'll never go through. There's no way they're going to ban them. But keep in mind, menthols make up 30% of Altria Group's earnings, something that you don't hear about under that Marlboro category, right? Like, I just don't think people understand how poised that these companies are fully reliant on smokers. And I just think people are not going to be smoking like they once were, and that trend will continue. But I want to ask you guys, what are you trading for high-end dividend income? Because I am honestly torn on if I sell my sin stocks, if I can find the best sin stock, which could be Philip Morris. They're much more diversified than Altria. I don't know. Maybe I'll just redivert them into something like that. However, does that set my portfolio up for the best long-term potential? Because obviously, if you've been holding MO, you haven't been getting capital growth out of it. Like, maybe you bought the dips at the bottoms and you did good. I'm up like 7-8% on my capital gains, and I've held this thing for years. But all my return has completely come back from dividends, and I've been reinvesting them. So you have to calculate that into the return as well. If you collected an 8% yield like I have for the last few years, I mean, and I'm rediverting it always into other stocks, I mean, that you kind of have to calculate that in, right? But I don't know what to do here. I'm looking at like the S&P 500 index, and I'm like, hey, at least you're getting 1.5%. You're going to be getting a 20% yield if that keeps going on the capital growth side, which again is speculative, especially in this high growth market. But I don't know, man. I'm torn. I'm so torn. Do I give up the 1,200 annually and I pop it in an index index fund, or do I diversify some of it into the Algonquin Power, just kind of bring up some of these yields that are only at 4% just to cushion some of the blow? And like I said, I'm still not even sure if I'm 100% ready to sell them. I just don't trust the sector. I just do not trust it. It's too tough for me right now, especially with the way that their books are looking to me. But again, I'm going to go through it a couple times because I don't make decisions on a whim. This is something I've been fluttering around with for a few weeks now, and after these earnings, I'm still leaning in that direction. Stay away from oil and pipelines. Yeah, I know a lot of people are pumping Enbridge in here. I actually don't mind Enbridge too much. I think some of the pipeline industry is really well poised. Actually, I think Algonquin Power actually has some exposure to natural gas pipelines. I think if there's going to be good use for pipelines and natural gas, oil specifically, I'm not a fan of the oil sector because it's just the same. It's the same thing as the tobacco sector to me. I mean, it's so hated. There's not never going to be good political stance on the tobacco sector. So the stock will never be getting hype growth. That'll never come. If it's going to grow, it's going to grow based off earnings and just people wanting yield. That's not going to be like your super hype sector like Tesla. You're never going to get that kind of growth out of the sin stock sector, and you'll never get that kind of growth, in my opinion, out of the oil sector, except for fair value underlying fundamentals, because you need to have that kind of Robinhood retail investor pump. You need to have people getting excited about it, right? And ain't no one excited about oil. Ain't no one excited about tobacco. You don't see anyone talking about that on the Reddit forums, and God knows Google Trends doesn't point in the right direction for those companies either. So I got screwed on oil in the early days. I remember when I first got into investing and I was an idiot listening to Kevin O'Leary on BNN before we had any big YouTubers out in the world. And he was really pushing the Canadian oil sands. He says, every Canadian needs to own the Canadian oil sands. Canadian oil sands is like Canada's hugest, commodity. It's going to be great. You got to hold this. So I buy it. And sure enough, it flatlines. It gets bought out by Suncor. They completely leave Canada. It becomes a U.S. driven company because of carbon tax and all this crap. Kevin O'Leary has not 100% been right. And that really tinged my taste for the oil sector right away. And I never bought back into it. I can't stand the volatility. I do not like the fact that it's so controlled by foreign government. I think it'll be around for a while. I think there's great money still to be made in it, just like the sin sector. But you just got to recognize like the long-term trend, right? Like they're all shifting into renewables. They're all trying to, there will be a day when the last drop drips from these oil wells. And I don't know what the hell that's going to say for Russia or Saudi Arabia. And they're all pivoting. If there's no better sign than the pivot from oil, look at how Saudi is desperately funneling money into all these other high-end industries to try and start shifting themselves in the next 30 years away from oil. I mean, they were buying into cruise lines, for Christ's sakes. Like, they've been doing everything they can to start making this shift, because the trend is your friend, and we know where that trend is headed. So this comes back to that statement, like, you can't always just be chasing yield either, right? Like, the oil yields are great, the sin stock yields are great, but again, you've been turning a blind eye to the fact that the S&P, the safest investment you'd make, is popping out 20% returns before dividends, right? So it's just like, you have to kind of justify, do you need those dividends today? And if you don't, I mean, you kind of got to take a step back and just immerse yourself into understanding what you're giving up, because I really like some of the cash flow, but damn, it's hard finding real cash flow these days. Dividend stocks are dying. It's such a shame. It's such a shame. Dude, quick question. What do you think about MERSK? I have absolutely no idea what that is, but this is a Q&A. I see someone's YOLOing on MindMed. I still like MindMed. I don't hold it, but like I said, that I feel like there's a lot of problems going on with the board members right now, because obviously they lost JR, and I don't think that was an intended deal. I think something dramatic came up within the company, because to lose a guy that was trying to front this into a huge company all of a sudden, I think there's something really bad going on. I haven't made any videos about it. I want to, but I don't want to be that guy right now. I'm waiting. I want to cause the drama. I want to stir the pot, but I don't. I like the company too much to stir the pot, so it bothers me a lot, because it's such a good vibe, change the world kind of company, but something is going on with JR, and I don't know what it is, but it is not good for him to have been forced down from his position. But again, who cares? This is a trial-based company. I think its anonymity from any of the people running it. It's just these trials. They got to get through them. It all comes down to paperwork and handing that paperwork off. I don't think you have to be a genius pharmacist or some crazy smart guy in the science field to pull off a pharmaceutical company, because it's all government regulated through phase trials, through people that actually can run them at universities and stuff. Sorry, I'm getting sidetracked from looking up this company that you're pushing me here, my brother. It's MAE. What is that? Oh my God, what a ticker symbol. Is this like a foreign, like European company -B? Anytime I see these, I think of the Frankfurt Exchange, because they just use numbers and letters a lot. I'll look it up real quick. I can't promise anything because I don't want to make the stream forever. The AP Moeller Merck's AS Class B. What the hell is this? It's trading up 36% this year. And I don't know what this is. Complete AP, view real time. What is this, man? Give me a highlight here. This is like the weirdest stock I've ever seen, because it's definitely a foreign stock, but man, that chart is flying, just flying. You can give me some insight there. I'm looking for high yield though. Give me some high yield, baby. And again, I'll reiterate this because this has been a conversation of choice when we're talking about options funds like QILD. There's JEPI. There's the Canoe Fund, which is like Canadian based. And I've been going up and down these too because a lot of the guys in our chat group are getting them. These things yield 8 to 10%. But the problem with all these options funds is they have caveats to them where there's always a downside. Like it's never a perfect fund where it just consistently yields high cash flow, because a lot of these option ETF funds, they're primarily based off the market going sideways. So they do great when the market doesn't go up. Unfortunately, we live in a market that goes up, and this is why I like JEPI a lot. I think it's GEPI. JEPI is poised in a way where basically if the markets go up, the stock price will capitalize on the markets going up. However, the caveat is the yield goes down. So if the markets trend higher, yeah, at least you capture the capital growth, but you'll notice their long-term dividend yield has been declining. So you're not getting a reliable long-term income source. And this is my problem with these option ETFs, because I would rather just own a physical company and forget the yield, because then I can get a compounded rate of return yield. Because if you can just be patient on an Algonquin Power that doubles its dividend, or it should hopefully continue to over the next decade, your 4% yield goes to an 8% yield pretty quick. And then if you're in the market for say 15 or 20 years, holy crap, like if that shit continues, I mean, you're going to be looking at a 20-year retirement, especially if you're only 30, or if you're like my age, which is 30, right? And you're buying these, like even by the time you're 40, your portfolio should be yielding a really decent return plus capital gains. I'm pissed I didn't pick any up on any of the dips during the Suez Canal crisis. Yeah, those are interesting plays, man. I've played a few of those, and sometimes they work out in your favor and sometimes they don't. Like use what was the last example? Like Alibaba, right? Like I played the Alibaba dip, the first big dip that I had, and I made a decent return real quick and I flipped it. I'm still holding the position for some people that I know. I'm debating on what I'm going to do with that as well, because the political rhetoric is so crazy, but I like the company a lot. Sometimes, man, even though the company dips so much and there's so much political rhetoric, that doesn't really change the fundamentals of the company. The stock won't turn around. But the Suez Canal, like I love looking for those plays in the market where some news article destroys the stock and you can just play a quick swing trade. I don't day trade a lot, but yeah, I do swing trade, not often. It's a blue moon event for me, but the pandemic really set up a lot of swing trade events. Because like I said, I wouldn't touch airlines with a 10-foot pole. Airlines got destroyed. They put themselves 10 years in debt. The airlines thought they were untouchable, the most recession-proof investment ever. They spent all of their money doing share buybacks, CEO increases on friggin' salaries. Like they just did the worst stuff imaginable, did not save enough cash. They did not follow the basic rules of investing, like at least keep some emergency fund aside. Those companies were crushed in the first 3 months. They were taking billion-dollar bailouts. And when you look at the revenue loss quarter over quarter, something for like Air Canada, it was in the billions, for Christ's sakes. They were losing their entire yearly income every single quarter. So, and people are bullish on them somehow. I'm like, yo, it is going to take 10 years of earnings if they can even get back to that level of earnings. And I don't think they will. I really don't. I think they put themselves in the hole for way too long. And you got to be careful. However, that does not reflect the stock price. Those stocks dipped to a level that was crazy, and you made a great return if you bought it for a flip. But you got to recognize that the fundamentals suck. Doesn't mean the stock price sucks. I mean, I took a lot of advantage of companies like that, man. I had a great time with it. I mean, a lot of these fundamentals changed, but who cares? The volatility of the market does do good trends for people that want to make some quick returns. I don't trust Chinese stocks. I agree. I do not trust the Communist Party to some degree. I do trust the companies. I think the companies, I don't think companies have borders. I don't think it matters. I think they're forced into regulations that suck. I think the CEOs got kicked out of their positions. I think a lot of that is absolutely horrifying from an investor standpoint. But from a business standpoint, China is trying to solidify themselves into a future they want to see where they can start dominating. They're fighting, obviously, for global currency control because they hate that the fact that the USD dominates. However, again, Apple operates globally. All these U.S. companies, though their headquarters are based out of the U.S., yes, they're not facing the same political headwind. They've come close. They wanted to separate Facebook up. They wanted to put sanctions and stuff on Amazon, but they just kind of put it aside. They're like, hey, we're getting rich. These companies keep going up. In the U.S., we want to own these companies. I'm guarantee you everyone on those boards have some exposure, or these government boards have exposure to those companies. So I guarantee you that they're like, oh, let's not screw this one up, boys. Yeah, you guys are doing good. You sound great. Well, let Zuckerberg off. We're not going to split up Instagram. I mean, in China, however, it was a different story, right? So, but it's kind of all following the same rhetoric. They're like globalized companies. They don't have borders. They just have, like, if you live in the country, there's regulations. You're going to run into them. But still, look at Baba's earnings, for Christ's sakes. I don't need to rant about this, but I've never seen a company like Baba, and those people are still going to buy their products. Amazon is largely poised off Baba's products. I can't even express how many products people are buying from China to sell on Amazon. I swear it has to be like half their inventory. So there's that side of it, and it's just like they're still posting great numbers, guys. They're way too cheap. They're just way too cheap, and it's just a matter of political rhetoric is going to keep driving the stock down, just like the oil industry, just like the tobacco industry, guys. They're great companies. They're still show great fundamentals, but people have to like the companies. People have to get past the political rhetoric. And so with Baba, I'm honestly going to say if you're buying it, I think eventually the fundamentals are going to be so great. People are just going to have to be like, hey, I might as well buy back into these. Chinese government, Communist Party is powerhousing their economy. I don't know. You're making bets, right? Do you think China's going to push their economy forward? Maybe just buy VTI, the Vanguard Total Market Index Fund, because at least in there you're getting some exposure to these Chinese companies, which again, in 10 years' time, who knows? Maybe they start dominating. I mean, Baba's working on self-driving too. Like, these companies are really forefronting major technologies, right? Bank ETFs are doing great. ENB is doing great. Let me look up Enbridge. I know so many people are a big fan of Enbridge. I just never bought into it because of the oil exposure, but heck, maybe it's a good buying opportunity. I know it was way too cheap. It's been trading up 22% this year, so it's keeping up with the indexes. Yeah, the 5-year return is still relatively flat, but you're getting a 6.8% starting yield. See, this is my problem with Enbridge here, is they haven't grown since since 2015 timeframe. I think they peaked in 2015. They're currently paying out a 6.8% yield. So if you're chasing yield, I think Enbridge does good increases too. It's great, but again, it's kind of like MO. Like I said, if you're new to investing, there's only two factors that I always take into consideration if you're not doing due diligence. If you're not doing due diligence, and again, this is where you kind of could run into issues with some of these high-flying stocks, is if the stock chart is not going up and the dividend is not compounding, it does not make my list. Usually when I look at companies, before I deep dive down in them, I say there's two things that these companies are doing. Stock price goes up, dividends increase. If you can do that 9 times out of 10, I'm already liking your company, and it's just a matter of what your product is and is it going to be sustainable long term, right? What about Northland Power earnings? Yeah, Northland Power's they actually took a bit of a shit kicking on their earnings this time, and I'm kind of concerned. My concern with Northland Power is their damn company needs to figure out what the hell they're doing with offshore wind. Like, they have been having so many problems at the Gemini project, which is one of the largest offshore wind projects in the world. It has been like under commission, like out of commission for like a good solid several months now, and it's all because they're having issues, I think, with the bearings and some of the turbines. I don't know. Every time I listen to these friggin' earnings reports, there's just something else going on at that project, and it's really hindering the earnings growth, because there's too many repairs. There's not a lack of income right now for them. However, I mean, their earnings post was reasonable. I think they're overvalued still here. I think they're kind of expensive, to be honest. If their earnings kept going up, I think they would have been a great value, but they're not. When you look at something like an Algonquin Power that trades for like a PE of 10 or 11, I think Northland Power is still trading in like the 30s or something like that. It's high, but that's the renewable sector. If you want pure renewable plays, you're going to be paying that premium, right? If you're looking for a dip buy, you want some of that kind of growth in the renewable sector, then maybe start picking up some here. It's got a 3% yield. However, it does not fully meet my criteria. They don't increase dividends fast enough, in my opinion. They've done one dividend increase since I've held it, and I think that was back in 2018 or 19. I've been in this stock for about 7 years now. It was one of the first stocks I ever bought, and I can't sell it because it pays me $50 a month, and their earnings aren't that destroyed yet that I feel like I need to get out of it. And I don't know. It's just an OG company to my portfolio, and I like the utilities. They're extremely stable, even with the earnings drop they experience. The stability in the business is it's guys, these are long-term contracts. This is another reason I like Southern Company a lot. Southern Company also has exposed to oil, and they got hit pretty hard on that segment. They saw a bit of a revenue decline through the pandemic. However, guys, they're running, and I think they're also experiencing some problems and extra expenses in opening up nuclear power plants. But again, these utilities, guys, they're not fun. They're not exciting. But my God, do they do a great job over the long term with dividend increases. And the stocks, almost all of them have increased, maybe not at the rate of the S&P, but for dividend income, I don't think it gets more stable. The only thing that's going to disrupt them is Tesla batteries. But with Southern Company, once those nuclear power plants are commissioned, baby, you're talking about 60 years of stable income. When you start one of those reactors, you ain't just turning it off. But I love my reactor plays, man. Those are like the best business model ever. You get the government to sign up and boop, turn the switch on. Hey, we're come back in 60 years when this shit cools down. We can't move this thing now. I love those for those reasons, but you're also getting a lot of other exposure. I mean, with Southern Company, you're getting, I think they do everything from like dam, waterway, like energy to they're getting into solar, wind. Algonquin also gives you some water filtration companies. Like they're so well diversified. Transmission lines, my favorite, by way of all the utilities, is transmission lines. You get exposure with that through Algonquin Power. Transmission lines, guys, it doesn't matter who makes the power. Doesn't matter who's running the nuclear power plants. It always has to run through the transmission lines. It don't matter if Tesla comes in and disrupts utilities. They still got to use the infrastructure, baby. So there ain't no better business out there than utility lines. Need more info on nuclear. I think nuclear is going to be one of the biggest industries in the coming decade, and I think it's the most underrated industry. In fact, I just did a sponsored video with UEC is the ticker. And I just don't think people understand, of all the commodity sectors right now, uranium is just starting to grow again, and it hit bottoms, I think, like a few years back, and it is not growing like, say, copper's been going up, or gold, or some of these other metals and minerals like lithium. And however, what people don't understand is that uranium nuclear power is actually more carbon efficient than solar panels. There are more carbon emissions into making solar panels work, and the amount of ground that they cover causes more damage to the environment than the actual power coming from nuclear. It's just a fancy way to heat water up, but there's no carbon, right? So, and it doesn't take up a lot of land, and you'll power hundreds of thousands of homes. And I just don't think people understand that China is increasing their nuclear exposure by 50%. The US is trying to bring nuclear back home. The US actually imports all of the uranium. All the uranium they have in the US is imported from foreign countries. So UEC actually got a license, and they are stockpiling 2 million pounds of uranium in the US, and they're buying it abroad. Well, they also find uranium mines, rich uranium mines, that they are going to be going into mining production with. I don't own or have any exposure to the nuclear sector except for Southern Company, but I am really bullish on it at these levels if you can find a right way of getting into it. And I know some of my subscribers have exposure in UEC, but I think it's a fascinating sector for sure. What do you think about NHF? Now, is this the medical property, or is this the, because I know you're talking about one that I've looked at a lot. I get confused because there's a new Canadian dividend stock that pays a really high yield that nobody even knows exists. And I think it's either NHF or it's the other one. And I get them confused because they have roughly the same ticker. NHF, I think, is the medical. No, wait. What are you sending me here? This is a REIT high yield Next Point Strategic Opportunities Fund. This is not the, this is the right yield. This is what we're talking about here. There's no way. This isn't, it's up a lot, but is that the right one, my guy? Yeah, North Canadian High Yield Residential Fund. That's the one that I'm talking about. You actually have it on point. This is the one I think that has a lot of it. Is it Northview? Let me just look it up. I feel like an idiot if I'm just throwing this off the top of my head. Northview REIT stock. Sorry guys, just bear with me here. I wish I had screen share. I'm going to sign up. I got good internet now, so I'm going to be signing up to StreamYard to try and get you guys some screen shares while I'm talking about this. Or wait, is that NVU or NHF? I'm going to look into this after. I talk about these stocks a lot. I'm going to bring it back up. But yeah, the Northview Canadian Residential Fund. I wish I could just bring up the stock price. Why isn't it giving me the stock price on this? 1685. There we go. And it doesn't show me the yield, but this is one that I've actually looked at. It jumped up a lot. What the hell happened there? So anyways, for those of you that don't know, this is a residential fund. It's primarily located on the outer skirts of the primary cities. I know there's a lot in like Yellowknife, Nunavut. I looked through their books, and I do have some concerns about it. I think there's a lot of risk. I'm surprised it's flying up so fast. This one, I kind of wish I bought a little bit just because their books are relatively robust. But just to point it out, there are a few things in there I don't like the lack of tenants they have, I think, in Alberta. Some of the real estate is hindered a little bit, but we'll come back to that maybe for another video for another day. What do you think about the Canoe Fund? Is that I think you're talking about the Canoe Fund, right? Yeah, that's one that I mentioned. That's one of the high yield. I think the high yield option ETFs. And like I said, I'm on the fence with kind of transitioning here. So just to give you guys a final highlight here, and maybe we'll finish up with a few more Q&A. I'm going to try. I'm not there yet. And again, I try and do this methodically as possible. I usually, like I said, don't make these decisions overnight, but I am severely thinking about just ripping it off like a Band-Aid, perhaps getting rid of my MO, perhaps getting rid of my British American tobacco. And those are hard decisions. I'm not conclusive on these yet. I'm giving up almost an 8% yield across the board. It's going to hinder about $1,200 of my annual income. And to put that in perspective, my annual income is about 80, what is it? It's on the board back here, 8,600. So if I cut that back, I'm going to be dropping my yield back to roughly 7,500 ish. Which is still fabulous. I mean, that's still a really big dividending. I mean, it's over $600 a month. However, it hurts. It bloody well hurts because I am a tried and true dividend investor. Guys, I don't care about dividends as much as I care about the businesses that I own. And I would gladly take a dividend cut and some short-term pain to know that I'm making my portfolio like a lifetime more robust portfolio. And I notice PPC Ian doesn't even talk about MO anymore. I've watched quite a few of his videos recently, and I mean, the guy doesn't even mention it when he brings up his portfolio. And like I said, I don't want to promote trash as much as I can. Even the sponsored videos, guys, they've been great lately. I mean, I try and pick the best sponsors. I know a lot of people don't like them, but I do enjoy learning about them and interviewing the CEOs. Guys, it's such a tough decision. What's your plan going full growth? I'm not going full growth. I'm a diehard dividend investor. Guys, it's companies over dividends matter more to me. And if I can buy an Algonquin Power, which I will likely put some of those funds into Algonquin Power, I'm much happier knowing that that business model is more fundamentally poised to the future than what MO is currently experiencing. Because like I said, if they just got their foothold in one aspect of a new industry, Kathy Wood's quote always lingers in the back of my mind. If companies are not taking advantage of the innovation that is going on across every sector right now that is leading to these high rates of return in the broader market, they're losing. They're just losing. There's only two kinds of companies. You're growing or you're dying. And though MO can make their earnings look like they're growing, their fundamental business is dying. And it continues to die pretty much across their vast, largest sectors. And it scares me. It honestly scares me. I wish they talk more about it in the earnings calls, but they don't. They try and talk about the growth and the problems they're having with their growth. But when I Google the top selling vapes, and none of them are coming from these tobacco giants, it is not a good time in the industry. They're not dominating any aspect of any of their business models, which sucks for me. So yeah, I don't want to say I'm a growth investor. I mean, 30% of my portfolio is now in growth between Tesla, Microsoft, and Apple, which those are like the gems at the top of my portfolio, in my opinion. I think those companies to not have exposure to just, oh my God, to be bearish on Tesla right now hurts me inside. There's so many bears out there that it makes me want to buy more stock because it makes me understand that there's still a huge amount of the population that has not recognized where Tesla is going. And it's just the writing's on the wall at this point, man. Like I did that video where, I mean, I don't want to get into it. I don't need to do a Tesla rant today, but it's same with Apple, same with Microsoft. People are like, oh, they're too expensive. And, oh, you know, I've held Apple for 6 years. I'm capping a 5% dividend yield off of it, which friggin' blows my mind. I wish I kept more of those shares from the beginning days, but I got caught up in the bullshit. Every single year, there is a guy that will come out and be bearish on Apple. Every single year, they have been wrong. For the last 6 years, I have been in that stock. Like, are you effing kidding me? I've heard Jeremy from Financial Education be bearish on it. I've watched people short bet it on earnings. I have heard it all. And to not have exposure to what these companies are achieving is just absurd to me. I'm like, what are you buying that you think is so much better than these companies that are making more money in one quarter than the bottom half of the S&P 500 companies will ever make in the next 5 years, for Christ's sakes? Like, to not have those companies and to think that you need yield over those kind of companies is just absurd to me. Just bloody absurd to me. Because again, like, you got to understand that you can sell stocks to yield. This comes back to my point that, like, if you have an emergency fund, you put $1 million into the S&P 500 and it goes up 20 bloody percent, which is already up 20% in the first 7 months of this year. You pull off 5% on $1 million, guys. That's $200,000. You pull off 5% of that, that's 50 grand. That's a whole year's salary. And look, you still have a capital gain of 150 grand that you're leaving in the market. Do dividends matter if you understand that? Now, to a degree, I believe in balance, because if you can pull some dividend yield and get that kind of growth and not have to pull any of it out, you're great, right? But you got to balance all of this stuff out, because to focus on one or the other usually gives up something that will be beneficial in the long run, right? Like, if you only focus on S&P 500 and this growth cycle comes to an end, whenever it does, it could be a year from now, 5 years from now, 10 years from now. I don't know. This is the greatest growth cycle in the stock market history. But when it ends, like it did from, say, 2001 to 2016, when the S&P did not grow at all, that's when your dividend stocks will make up for that lack of growth that you're experiencing in the S&P. But to deny one or the other is just, it's not going to do you good in the long run. So I mean, I'm stuck, man. My head is spinning like a top right now, and I don't like having to sell my favorite stocks. But because I just went through this with, it's really reminiscent to me of GEO Group, right? Like, GEO Group, I held on to that sucker for 2 or 3 years. I got slaughtered, like, took to the slaughterhouse. That was a prime example of how fundamentals don't always matter. Fundamentals don't always represent the long-term effect of where the company is going. And, I was one of these guys where I'm like, they're too cheap. They're too cheap. You could say the same about BABA. Like, when political rhetoric comes into play, like, the risk level goes way up, because, oh my God, guys, like, I could have showed anybody GEO Group's books and told them that it was don't tell them it's a prison stock, and they would have been like, I got to buy this, because my brain was just flicking off like crazy. Like, holy crap, these fundamentals are unbelievable. So I bought the dip, I bought the dip, I bought the dip, I bought the dip. I got on Netflix because I was making videos about it. No one was. Kept buying the dip and eventually sold it for 50% loss. And the dividends kept getting cut. The dividends kept getting cut. Now they don't even have a dividend. And I honestly don't want to say that's the direction MO is going to be heading into. But like I said, guys, it kind of has those reminiscent vibes where the political rhetoric keeps getting worse. They're not growing. And frig, like, what's the long-term effect of this? When does that inflection point hit where, like, the political rhetoric and the lack of growth just finally catch up with them, and the stock starts just getting slaughtered in the other direction, even though it's cheap, even though it's a real cheap stock? I'm really concerned. I need to get on the Q&A. I want to ask the CEO some stuff. Maybe I'll send them a message or call up their investor relation and just voice some of my concerns to see what they bounce back at me. Because you can do that. It's something I've never done, but maybe I should. You can just call up the investor relations at these companies and ask them any questions you want. Maybe I should do that. Do you think the market is overdue for a 10 to 15% correction? I absolutely do. Well, it could correct at any time. I don't think it will. I honestly, look, for any reason, the market can drop. Any reason whatsoever, but the PE ratios are finally coming down because growth is keeping up. This was my biggest concern of the broader market, because nobody can predict the broader market. Anybody that can sit here and tell me how Apple's going to perform is ignorant. To think that you understand the scale and the scope of $1 trillion business that is only comparable to the GDPs of countries, you can't sit here as an analyst and act like a smartass and predict what's going to happen. You just can't. Trying to predict the outcome of economies is damn near impossible, and to think you have a chance at that is ignorant. The only thing you can do is just nicely diversify a portfolio to take advantage of any situation you can appear that would be coming. And the only thing that red flags me the most in the market is obviously the PE ratios, the valuations of the broader market. And those were getting into the 40s. And we haven't seen PE ratios this high since the dot-com bubble, since the 2008 financial crisis. And it is uneasing unless there is one good valuation metric that makes up for PEs, and that is growth. That is revenue, that is earnings growth. And when you look at the top weighted companies being these massive conglomerates that are growing at rates penny stocks only wish they could grow at, all of a sudden, like, you start understanding the market we're in. And this is what Kathy Wood keeps iterating. We are not in the same market we were in 10 years ago. We are in the greatest growth cycle in human history. You have to recognize this. We have not seen a market like this since the Industrial Revolution. Every sector is getting changed. The financial sector is going to be introducing some version of blockchain, whether it's their own version or something. Digital currencies are coming out. The entire way we deal with the back end of stock, just doing the stock housing on the back end, as Vlad from Robinhood mentioned, like, they're going to be changing that up because it takes 3 days to settle a stock. Blockchain solves that problem. When you look into healthcare with genomics, the cure to cancer, HIV, healthcare is going to potentially overtake. I honestly believe healthcare will be one of the largest sectors in the future. I think it's going to take over. Perhaps it'll make its way onto the top 10 S&P list because, God, you solve heart disease, cure cancer, you extend life expectancy for another 20 years. My goodness, guys, that the value in that is going to be astronomically in the trillions. I mean, that's health. Like, this is shit people weren't saying when I was a kid. I remember when I was a kid, we were still debating on whether global warming was a thing, and there wasn't any renewable companies. Talking about putting up solar panels and stuff was nuanced still, right? Like, that was not a big deal. But now all the entire utility sector is getting disrupted by Tesla, renewables, etc. I mean, pick one sector of the market and tell me that it's not being disrupted. That did not happen. I mean, going from like the 80s to the early 2000s, that was not happening anywhere. I mean, the big thing was telecom. Telecom was expanding. I mean, just general industries that have been around since World War II were still coming into full fruition, right? Like, they haven't fully breached past that kind of revolution that happened back in the World War II area when all these innovations started coming out. But now we're in a place where AI technology, cloud computing is at a rate that just didn't happen. Guys, keep in mind the iPhone didn't even come into existence till what, 2009? And look at what that has done. And that's one technology. I mean, and it's just so mind-boggling to me that people don't appreciate the reality of it, right? So if we are in a true growth market, like Kathy Wood says, and we are in an innovative market where if you're not innovating, you're dying, then yeah, it makes sense for the S&P 500 to have a much higher PE. This was not true in the dot-com bubble, and this definitely shouldn't have been true in the 2008 financial crisis, because in the 2008 financial crisis, there was just too much money floating around in bad debt. It had nothing to do with the fundamentals of companies' growth. That's when you have to be concerned, when PEs go up but fundamentals don't, right? So I am highly bullish on this market. I honestly think you need exposure to the growth cycle we are experiencing, and if you are not matching the S&P's returns, you have to justifiably change up your investment strategy, because again, if, and there's no guarantees, but if this growth cycle persists for the next 5 years, think about that compounded rate of return. I don't know, guys. 20% a year, you're going to double your money in 5 years. No guarantees. I'm not a financial advisor. I'm just able to recognize the market that we're in, and I hope everybody else is as well. And when I look at something like an MO that has not done anything for me but flatline, and yes, pay me a decent 8% yield that has increased, I'm giving up 12% of market return every year I've been holding that. If I just put it in the S&P, I would have been making way more than that over 3 years. I'd be up 60% return plus the dividend yield, and it would make my MO position look like a joke. But again, I like balancing with yield. So any final questions and answers? Do your own due diligence, though. 100%. 100%. I like I said, I'm very fortunate to not have a full-time job or work any real job for that matter. I kind of just stick around as a clown here on YouTube. That I keep forgetting sometimes, because I think a lot of people underestimate their value of knowledge that they're able to gather. Because for me personally, I think I'm an idiot 9 times out of 10. I'm like everybody else. I have anxieties. You know, I'm a little socially disturbed about some things, but I have to recognize that unlike most people, I sit here every day and this is all I do. I look up stock earnings, listen to MOs, conference calls. I do all of this stuff, right? And I have to recognize that 90% of people don't do that. And that has an incredibly large amount of value. to my investment decisions. And I think it's something that most people, if they don't have time to do, they have to recognize that, like I said, how many of you actually are looking at MO's earnings that hold MO? I guarantee you most of you don't, right? Like I get up and edgy about things. If I find one red flag, I start dissecting it in every aspect to figure out how it relates to their total earnings and the future potential. But I'm a bit of a nerd that way, and I enjoy it. I wish I learned more in school and paid attention to like multiples and to the powers of, because in the investing world, actually, this is a cool little metaphorical thing, maybe to just touch on while I finish up. I love Neil deGrasse Tyson. The fundamentals of nature really make up a lot of the biological thought process, and the way the markets work is that it's a nature thing, right? Like it's not some just binary like 1-0, that's it. It's very much based on human emotion and nature just baking into the global markets. And I think it's fascinating to think that when you look at exponential growth, that's everywhere in the universe. Everything is exponential. And like there was a funny example of like algae in a pond. If you look every hour, you'll look at the algae exponentially populating, and you can calculate out at that exponential rate how fast the pond will get covered in algae, and it's relatively quick, right? And I don't think people understand exponentials enough, because it's something they didn't teach us well enough in school, and it highly bakes into the market, because that's how we get these crazy exponential returns, right? Are these companies like algae that just start populating, and you have to find those companies that have that true exponential rate of growth. These are your Googles, your Microsofts, your Teslas, your Amazons, and they are just disrupting the entire ecosystem. And it's kind of fun that like a lot of like universal laws actually come into the stock market. And I think if you can start getting past like the emotional conflicts that people face, and you can start looking at it from more of a just like a really just I don't want to say binary again, because binary, like I said, it's just there's no simple outcome. There's too many variables, but you're kind of just placing the highest degree bet that you can, right? Like this is what I always said. Like there's risk in everything in your life. We walk across the street, you don't look both ways. You're not a pessimist, you're taking a risk. Pessimists always survive. The pessimist is a guy that drives through a green light, but still looks both ways, even though these guys have red lights, because that doesn't mean some idiot is going to come flying through, right? So pessimists in the market will always survive, because these are the people that are actually always concerned, even about their best companies. They're always double checking. They're a little concerned all the time. So it like you just have to approach the market from kind of like these fundamental bases, right? Like you want to be really paranoid. You don't want to think that everything's going to be great, and you just want to make sure you're finding some of these exponential rates of return. Sorry, pessimists hold cash. I agree to some degree. I think a pessimist is just somebody like myself, right? Like I'm a pessimist in believing that I would rather you argue with me about a company that I own. I don't believe I perform my best until somebody's willing to debate me on something that I believe in, because an idiot hangs around people that say yes to everything he says. I'm sorry, but the markets are very competitive. And if you think you're right all the time and you surround yourself with yes men, you are going to fail. It's just a matter of fact. Like when I was buying Tesla in 2019, when I was buying MindMed, do you know how much headwind I took? Do you know the emotional tolerance it takes to deal with that shit? I mean, you look at in 2019, I bought Tesla for like 300 a share, and it dropped to 150. It dropped in half because of how many people thought it was too friggin' expensive, and they just did not do enough due diligence on the exponentials that company is going to experience. And they just couldn't figure it out. So I'm like, I'm going to hold this sucker because I just see it. Same thing with MindMed, right? Like, who the hell, imagine going back even just a few years back when we were buying MindMed for 30 cents a share. And I was telling everybody in my family, you guys should get exposure to this company. Like, this company's, and you know how many people are against that stuff? Like, I was trying to tell my aunt took the advice that I gave her to her financial advisor, and the financial advisor said I was absolutely nuts. I mean, I mean, everyone was saying I was nuts. My mom didn't. A lot of you didn't, and we made a lot of money. I'm like, there is no stock in the world where you're going to make a fortune that does not have that going on. Like any polarizing company are the companies where you're going to make the highest rate of return always, because most people haven't figured it out yet. And that's still true with Tesla, in my opinion. Tesla is what, $600-700 billion company. 40% of people still believe self-driving is 10 years out. Come back to me in 2 years. Let's see where we're at. To be fair, it was speculative. It still doesn't have revenue. What are we talking about? Well, yeah, of course they're speculative, right? But I mean, to some degree, yeah, I mean, they're speculative by nature for sure. But Tesla has revenue. I mean, they posted $1 billion, right? On their last quarter, which actually blew a lot of people's mind. But I don't think Tesla's business model right now is a spec. Okay, look, being a pessimist here, I would not have bought Tesla post 2018. I don't think people that bought it when it first started coming into fruition back, what, like 8 years ago, they act like they just made the greatest decision ever. And I notice a lot of people talk highly of themselves when you're looking at like these Tesla YouTubers that caught on to this really early. Like even Shamath Palpatia really gloats about how he was so smart catching Tesla in those early days. But I hate the fact that they talk like that because Tesla almost went bankrupt. I mean, Elon constantly talks about how they were a week away from bankruptcy, and if they couldn't find funding, they would have been toast. I'm like, do you know how much risk that is? And then to act cocky like you knew what was going on the whole time after the fact is just ignorant to me. And I really hate that because like I would have never bought Tesla. Like I've heard about them. We all heard about them prior, right? But you have to wait till these companies get a foothold in the sector, right? Like Tesla had a huge foothold by 2019. 2019 was the pivotal moment for Tesla, and you either figured it out or you didn't. And if you didn't, you watched the stock run up to the absurd valuation that seems absurd, but I don't think it is because they have a foothold across the industry and it's recognizable now. And even though it's recognizable, 90% of people, or for at least, I think at least 30 to 40% of the market has not realized it yet. I just don't think they have. So I think even from a market standpoint, from a retail investor standpoint, there's still going to be lots of room for capital growth and just exponential growth in their businesses once they start, scaling batteries and just getting involved in all these different sectors, right? The battery sector is going to be so big. Oh my God, the battery sector is going to be unreal. I don't think people appreciate this is so. I'm going to go down rabbit holes. I hope you guys are enjoying these rabbit holes, but the EV sector when it comes to batteries is, I think, one of the most underlooked at, underappreciated sectors when it comes to lithium and graphene mines. Guys, people right now, and I've done these with sponsored deals already, people are seeing the fact that the largest lithium producing companies, like one in China, have released statements saying that there are going to be lithium shortages by 2025. They're expecting in the next few years that we are going to be running into lithium shortages. And the companies that I've been sponsored by are literally just buying lithium mines. They don't care about mining them at all. They just want to buy the rights to the minerals. And then they just want to watch these companies scale. Like these stock prices are blowing up just because these companies know that they can get access to the lithium and they don't care about mining it. They're like, we'll let somebody else worry about that. Let us just capitalize on this, this crazy growth that's about to happen, and then we'll just sell them. Or maybe we'll consider mining them when we've made $1 billion off the stock going up. I think people don't understand how severely this is going to impact the broader market for competition. Tesla, GM just bought into a lithium mine. China's really been gobbling up lithium and graphene mines. They're the largest producer of the bunch. And what people don't understand is if you hold exposure to companies that need batteries, which is every automaker, they're going to get screwed. I don't think they're going to survive. I'm going to make this statement right now. I say this all the time. People think it's too far reaching, and I think they're absolutely wrong. And this is why I love the debate, because again, debating is where you're going to learn this stuff and figure out if you're in the right or the wrong. And anyways, I think 50% of car companies are going to disappear because they just can't keep up with the logistics and what we are about to see happen in the next 2 years. Tesla, on their last earnings statement, and I mean, they brought this up, which was fascinating to me, was that they can't keep up with their own battery demand. Their solar panel walls, their battery walls are 2 years sold out into the future because they can't scale batteries quick enough. And Elon said that they're going to be perhaps doing iron diodes. Iron diode batteries are much easier to produce because made from iron. However, they're not as efficient. Who cares though? He's like, if we're using them for specific things where they meet the requirements to do the job, who cares if they're not as efficient? We need to meet the demand. There's going to be so much demand in the next 2 to 3 years when all these companies start making this massive pivot that they're not going to survive. I just don't think when it comes to pricing, scaling, the logistics of just getting the stuff, because China is going to try and dominate the EV market. I think the only major competitor to Tesla is China right now. Ford is trying to come up, but their technology just isn't there yet. In my opinion, again, my opinion here. Okay, folks. So keep an eye on the lithium markets. That's another great growth market that I think still has a lot of potential for incredible returns, right? And I know some people that are really deep down into the mining sector. What do you think about GDNP? Wouldn't touch Cineplex with a 10-foot pole, much like Air Canada. I'm just trying to read through these. That's where hydrogen comes in. Hydrogen. Hydrogen is an interesting one because it works in some cases, but not in others. I don't think hydrogen is going to be the go-to for cars or transportation. However, I think it will be for airlines. I think airlines could use hydrogen. I don't know, it's an interesting molecule for sure. AMC movie theaters are open. I'll look up GDPNP. All right, you got me. It's a renewable container plant-based packing. Okay, I'll bring it up and I'll look into it. Please shout out, guys. I want to hear more about dividend stocks because that's where I want to pivot my TFSA MO capital. But like I said, I'm not selling it yet, but I'm gonna have to look. Good natural product. So this is a small cap. 206 million. It is trading up year to date, about 8%. I think I've heard of this one before. Maybe I'll have to take a look. Or is this renewable? Yeah, okay, I'll take a look into this one. Thanks for recommending it. Give me a little list here to go over when I'm done. I have a question. I'm in Canada. Which bank should I buy more of? I have TDRY, Bank of America. The Canadian banks. This is what I love about the banking sector right now is because going back to the beginning of the stream when I was talking about the guy that did this, literally the largest crypto heist in history, it's so funny because the Poly network was specifically designed to be 100% anonymity against the government and obviously against any kind of institution, and that led them to being hacked. Because here in Canada, when you're using something like these crypto exchanges, they take all of your IDs, your identifications, and they're very highly regulated. The Polynet network thought they would be a bunch of smartasses and they would avoid these regulatory issues and getting involved in government. And now they get robbed. They lose $600 million. And who do they go to? The first people they go to. Hey, regulators, we need your help. This guy stole all of our money. So I think this really proves that in tandem in the future, crypto is going to be working with the regulators, because again, I think in the future, you're going to have an option between decentralized currency and centralized currency as these governments and Federal Reserves start introducing their own digital currency. And this is why I think that the banks are so great. I love banks. I honestly think they're just, I'll give you a quick funny story. In the middle of the pandemic, the Canadian banks were yielding anywhere from 6 to 8%. They dropped in half. I sold Apple actually to buy Bank of Nova Scotia and Canadian Imperial Bank. Pat myself on the back for that one. Apple would have been a great stock to keep holding, but at least I capped like a 70 or something percent return from the time I was buying those. So like fabulous stuff. But my neighbor got in a big argument with me because I was all about REITs and techs and all this other stuff. And he's like, if you were smart, he's like, you would go and take out $100,000 loan from the bank right now and buy the Canadian banks. And damn it, he was right. He's like, because he's retired and the only stocks he owns are Canadian banks. He honestly thinks they're the only thing in the market you absolutely need to own. And you're not going to do yourself any wrong. I think the Canadian banks are better than the US banks. I think they've proven themselves to be more robust. And every crash, 2008, this pandemic, they always prove to come out better. They don't cut yields. They're just super robust because the Canadian economy is also still growing at a much rapid pace compared to the US. Obviously, we're much smaller, but we're still immigrating about 1.8 million people over the next 2 years. So that kind of growth potential, because that's why I love Canadian infrastructure. I don't like most Canadian stocks. Many of you know, I really don't like the Canadian markets. They severely underperform the broader markets, but we have sectors that I think are much better than some of the broader markets, and that's with utilities, telecom. I think our telecom is much more robust than something like an AT&T is right now. And again, these are all infrastructure-based companies. And again, in a growing economy that is outpacing percentage-wise than India right now, and again, much smaller country, easier to scale quicker from a percentage basis. But all those people need housing, they need telecom, they need it all. They need energy, infrastructure. So when I look at all these new builds going up in the city, I'm like, hey, damn, they're going to be plugging into power. They're going to be getting some TELUS. They're going to be getting it all. So why not own these companies, right? Like, you're going to be poised to take advantage of Canada growth. And the banks are a great way to do that. Banks are an incredible way, because we have 4 or 5 banks. That's it. Not like the US where there's dozen plus banks, right? Here I guess we do have some new ones coming up, like Tangerine. Tangerine doesn't promote themselves very well. I don't hear about that one at all, but I guess that's a newer bank. But we only have BNS, BMO, TD, RY, and did I say I think, like I said, we've only got like 5 or 6 banks. You just go and look at, this is the dumbest thing ever, right? Like when you look at like the banks try and sell you on bank ETFs, and someone's like, oh, should I buy this ETF? And I'm like, it only holds 6 banks. Why don't you just buy them individually? Like, why are you going to pay somebody a fee to hold an ETF that only holds like 6 banks? Like, it doesn't make any sense. Look at FTN.to. It's paying a 13% yield. I don't trust that. Anytime I hear 8% or higher, my like red flags go off in my head. I have a hard time finding any company that yields any near close to an 8% that actually has a really fundamental company. Yeah, so this one's actually trading up 17% year to date. It's the Financial 15 Split Corp. Yeah, but your 5-year return is down. So this is going to be another one of these, option ETFs where you're collecting a yield, but in a market probably where stocks go up, they don't do well. So, I mean, I'd be a little careful with some of these guys. Anytime I hear these high yields, I always, there's always a downside. There's always a downside. I got 8% yield on TD. Yeah, I really wish we were back in these pandemic levels. I hate buying stocks right now. I hate buying friggin' banks with 4% yields when you could have been getting 8. The market's changed far too fast. It hurts me inside. But I learned a lot, I learned a lot. This was a good learning experience for us. Royal Bank of Canada, JP Morgan are on my watch list. Yeah, if you want some global exposure, but honestly, I don't think you need the US banks. I think this pandemic really proved that the US banks are very, the government's scared. They locked them up. They stopped doing share buybacks, cut dividends. They locked them up. They couldn't do anything in the pandemic. Canadian banks their stocks just went down. Nothing happened. They didn't get destroyed. They didn't get government intervention. They weren't like forced to do anything. And again, go look at 2008. What happened to the Canadian banks in 2008 when most of you could have held in 2008, you could have held the Lehman Brothers. Could have absolutely, were they publicly traded? I'm not sure. But hey, in 2008, none of our banks went bankrupt. Our banks are banks, man. They're great. Expecting big dividend increases from Canadian banks when they're allowed to. Yeah, I mean, they're trying to build up to that too, but to some degree, I don't know. I like the banks. Let's not go on about banks during the lockdown. Can you lose on TD? You could lose on any bank. You can lose on anything. All right. Something could happen. I like Canadian Imperial Bank personally because they're really poised against mortgages. TD has so I'll give you a little quick rundown of banks. BMO is going to give you more exposure to the oil sector. They're really exposed to oil pipelines, etc. Okay, Bank of Nova Scotia gives you some global exposure because they're highly in some of the I think they're in Colombia. They're in some of like the Latino markets, I would say. So that's your Bank of Nova Scotia. They're kind of just like a general bank. They kind of got some mortgages, some global exposure. TD is going to be your US exposure. TD is highly exposed to the US. That's kind of like your Canadian US exposure because obviously you've heard of TD Ameritrade. It sponsors CNBC's Jim Cramer's lightning round all the time. Royal Bank is just the largest bank here. They give you some mild global exposure, but it's just kind of one of these general banks. The yield is way too low for me. I don't like the low yield that it offers. So I'd rather go with some of the latter. And then you got Canadian Imperial Bank. Canadian Imperial Bank is purely like a mortgage-based bank. So like if you buy all these banks, you're literally getting slightly different geographical exposure, slightly different mortgage-based exposure. Meanwhile, it's all poised by basic credit cards and mortgages at the end of the day too, right? Because it's what banks do. But I love them. I love them. I'm looking for a high yield REIT. Any ideas? Lots of them. Lots and lots of high yield REITs. I just bought MPW. I think it's at a great price right here. I wouldn't expect massive capital growth or dividend growth, but if you're looking for dividends today, I think they're highly reliable. MPW is great. Stag is great if it dips. We caught Stag at the best price imaginable. I wish I doubled down on that REIT because, I mean, oh my God. Stag, I gotta want to shake their hand. Smart Centers is interesting. I keep thinking about buying Smart Centers. That one I float around with in my corporate account a lot because I'm looking for something to continually get me cash flow. And I like Smart Centers a lot, but I ended up picking RioCan because I like the direct the Toronto exposure because RioCan gives you like the purest of pure exposure to Toronto real estate. And I love Toronto a lot. I understand the real estate a lot. They're going through some headwinds. Same with Smart Centers. The pandemic kind of rattled them, so don't expect any quick capital growth on the equity side from the stock. But for the dividends, I think they're reliable. Smart Centers, for those of you that don't know, is basically trying to build mini cities around their outlet malls. So smart centers in RioCan have been primarily known as malls. They're like mall REITs, outdoor mall REITs. And I living in Canada, I see them all the time. I drive around a lot. They're all over the place, the GTA, the city, even out closer to where I am in cottage country. And they've made basically smart centers and RioCan. Basically, any REIT that knows what they're doing right now are moving away from malls. This was something that concerns me slightly about something like an O Realty Income, though O Realty is a much bigger company and it's way more like, diversified and exposed out there. They're still primarily exposed to mall-based things, right? Like Shoppers Drug Mart, stuff like that. So I'm a little hesitant on that because I just feel like there's so much disruption going on in the mall sector right now that if you're not leaning into residential, that you're going to have issues. So for those of you that don't know, smart centers literally has outlet malls. They're like outdoor malls with like some food stores, some banks, some telecom stuff going on. And then they're like, hey, we have all this land surrounding these outlet malls. Let's just build condos around them, right? So I love that business model for them, but I've talked to some people that are telling me that they're not actually going to experience growth off that business model for some reason. And I'm curious as to I wish I could find the comment because I really wanted the guy to reiterate to me like where he's getting this thesis from. Because he thinks RioCan actually has good investment in the projects, whereas apparently Smart Centers is just moving around their capital structure to pull this off, and it's not actually going to change a lot of the yield income. I don't know. I got to look into it because I'm curious to where he's kind of coming up with that. He could be wrong, but I've looked at it a lot. I think about buying smart centers for my corporation just to get some cash flow. I definitely like smart centers a lot more than I like MO. I like real estate. Actually, one more funny story here, and then I'm probably going to finish up. We just had my buddy's bachelor party, and there's a guy that works for the municipality, one of my buddies, and he actually does tax loss recovery. And this is what I hate about Grant Cardone. This is what I hate about most real estate moguls is they try and drive real estate like it's a better investment than the stock market because you're not controlled by Wall Street or the government. And it's the biggest bullshit friggin' story I've ever heard in my life because in Canada, especially, and this is literally what the guy told me. This guy works for the municipalities. And when I'm saying tax loss recovery, basically what he does is if you do not pay your property tax for 2 years, this is the guy that's going to knock on your door. This is the knock on your door you do not want to have because this is when they give you your eviction notice and they put your property up for auction. What people do not understand is property. You could own $1 million mansion outright. If you obeyed paying your property taxes for 2 years, and your property tax could maybe only be like a few grand or $5,000 a year, maybe on $1 million property, it might be like 10 or 13 grand a year, probably a little higher. But if you avoid paying those property taxes for 2 years, even though your house is worth $1 million and you only owe the government, say 20 or 30,000, they have every legal right. And they will take these opportunities to basically say, hey, you owe us money, get the hell out of this place. We're putting it up for auction. That is what my buddy does for a living. And it scares the hell out of him when it comes to buying private properties with private individuals because he's like, nothing stops them from just not paying the property tax. Like that one little mistake could literally cost you an entire real estate portfolio. And I'm sure you could negotiate away from it and pay the bill, whatever, right? Like you could pull some credit out of the market. But I'm just saying it's a huge risk that I don't think people understand well enough to think that real estate is just some super secure investment that has no risk against like Wall Street screwing you over. Yeah, it's disconnected from the stock market, but it isn't disconnected from an insane amount of volatility risk where someone can just rip it out from under your feet, even though you own your property. You rent your property. It's not yours. What is Dave Ramsey saying? I'm not that religious on like any Catholic front, but it's God's money. It's God's real estate. You're just managing this while you're here. I mean, you're not going to take your property and your money into the grave. I mean, you're not going to, well, you could. I mean, you could do what Ben Mallet plans on doing and using his Rolls Royce as his casket. I mean, you're welcome to do that. But at the end of the day, you don't own anything. You just manage it. The government has all the control, baby. My dad used to say, if you think you own anything, just don't pay taxes for a while. Yeah, exactly. I mean, look at your stock portfolio. You don't think the government wouldn't freeze your stock portfolio if you didn't pay your tax and they wanted to come after you for your assets? You don't own shit. You just manage it. So last question, ap.un. That's That's another big REIT that's kind of interesting. I think it's a globally diversified REIT, is it not? AP.UN. I try and avoid the global exposed ones on the Canadian side of the border because I don't trust them. I don't understand the international exposure. Like one of the best REITs here is CAR.UN, and that's what Canada's largest apartment REIT, and they have global exposure as well. But I have a hard time. I don't know, buying global exposure. I'm scared of it. I don't understand real estate in foreign markets. That's why I like MPW so much, because MPW is just they're hospitals. Hospitals are the same in every country. I understand that. I don't understand how like a lot of this other real estate functions, but yeah, Allied Properties Real Estate Investment Trust is another interesting one. I stick to just a couple of them. Like I said, I just like the really inner exposed to the Canadian market. I understand Canadian real estate. I understand where the market's going. I understand the growth that they're trying to capture. So I'd rather stick to what I know and trying to avoid as much as possible globally diversified REITs. Nothing that there's wrong with it. I mean, it might be great for you if you go down into it and you like the diversification they have. Then great, go for it. But like I said, I try and avoid global REITs. Is there? No, there's not MPW on the TSX side. I wouldn't buy MPW if you're Canadian, unless it's in a tax advantaged account. Unfortunately, you're going to be paying a 15% withholding tax. I'm willing to take that hit. I think my 5 point whatever percent yield that I capped on that company is actually, I can't remember. I think it's a 4.8% yield or something like that after the 15% cut. But keep in mind, I'm not paying any income tax. That's why I'll do that. I don't mind taking a little bit of a tax cut if I can avoid taxes on the full income side of it. RSP doesn't, yeah. So with the withholding tax, yeah, you can completely avoid it. But I buy REITs for cash today. I don't like the RSP because I want to retire a little earlier. I want access to that cash flow. So I would rather own it in my TFSA. But that's me personally. Heck, maybe you want your TFSA to grow and you don't want the dividend income, then just buy some index funds or just buy some good growth stocks like your Googles and your Microsofts. You'll be fine. Anyways, folks, I could go on for days here. It's been a pleasure. A nice hour sitting down this Sunday. Appreciate you guys coming out. I got some fun content coming out this week as well. We're going to do a little bit more on TAT tomorrow because I kind of broke down why TAT has this incredible, like, just I can't get over TAT. Why the hell has an MO done what TAT's doing? It really bothers me. It honestly pisses me off. TAT just found this stupid loophole in the entire sin stock sector. They don't have to do any regulatory bullshit. They can promote themselves. And why the hell is an MO just being like, hey, why don't we just copy their business model? It take 2 seconds. It's anybody can do it. There's no regulations around it, for Christ's sakes. Oh, it bothers me a lot. I wish MO would just find a growth sector that works for them. Anyways, stay cool, stay awesome, folks. I'll catch you soon. Peace out.